Welcome and thank you for watching our credit improvement presentation. Our purpose is to provide to our community what it takes to build credit, what your credit report score is, and we also have a segment on budgeting. Sometimes people feel that they have a low credit report score and their score is always low, but that's not the case. You can easily build your credit, and we are here to help you in this presentation and tell you how to do that. Also, like I mentioned before, we have a segment on budgeting. The segment will let you know what you can do to budget your money. Thank you again for watching and enjoy.
First things first, how do you initially establish a credit score? In order to establish a credit score, you must open a trade line or loan. This loan can be a share secured loan, credit card, automobile loan, recreational vehicle loan, or unsecured personal loan. Your credit score will be created once you have a payment history of at least 6 months and have had activity reported within the last 6 months. Activity can be a loan payment, the opening of a new credit card, or a credit dispute. If you pay off your loans and have no activity for more than 6 months, your score will actually cease to exist. And if a financial institution runs your credit, it will say you have no score. Because of this, it's important that even if you pay off all of your loans, you should keep a credit card open and use it once in a while so that you have activity reporting and keep your credit score active. There are 5 factors that make up your credit score. 10% of your score is based on the types of credit you have. Revolving, like credit cards and home equity lines of credit, installment, like auto loans and student loans, and real estate, like home loans and raw land loans. This is also known as your credit mix, and you want to have a diverse credit mix, made up of different types of loans rather than many of one type of loan. The next 10% of your score is based on new credit or the accumulation of debt. If you apply for or receive too many loans in a short period of time, it can negatively affect this part of your score. However, you do want to keep your loan portfolio fresh. A good rule of thumb is to apply for new credit no more than a couple times a year. 15% of your score is based on the length of your credit. Your credit history is technically only as old as your oldest loan, which for most people is a mortgage, student loan, or credit card. Once you pay off and close your oldest loan, your credit history becomes as old as your oldest remaining loan. This is why we encourage members to keep their oldest credit card open even if they don't use it very often, to ensure that their credit history remains mature. 30% of your score is based on the amount owed on your revolving debt. If you consistently max out your credit cards or home equity lines of credit, it can negatively impact this part of your score. We encourage our members to use only approximately 30% of their revolving credit at a time to have the most positive impact on their credit score. The final factor, history of payments and delinquencies, accounts for 35% of your credit score. Every payment you make has a positive impact on this part of your score, while every late payment has a negative impact. Only one late payment can mean a significant drop in your score, which is why it is so important to always pay on time. However, everything is fixable. One late payment doesn't mean you'll have a bad score forever. Stay tuned for some tips on how you can improve your score. You might be wondering, what is considered a good credit score? At the Michigan Tech Employees Federal Credit Union, we use risk-based pricing, which means that the higher your score is, the better your interest rate will be. A score of 720 or higher is considered excellent and will receive the best rates we have to offer. A score of 549 or lower might not qualify for a loan unless it is share secured. However, if your score is on the lower end, we do have a few loan options that will also help you to improve your score, so keep watching to learn more.
Things that can have a negative impact on your score are having missing or late payments. Anytime you have a missed or late payment, these will drastically drop your score, so you want to make sure that you stay up with your payments monthly. Another thing that can hurt your score is having a high credit card balances. You want to keep your credit card balances low, and you want to make sure that you're not using more than around 15 to 25% of the balances available to you. Your best is to pay each credit card off monthly completely if possible, as this will help raise your credit score the most. Another thing that can hurt your credit score is shopping for new credit frequently and having too many new loans onto your credit report. The reason this is that every time that you apply for credit, there is a hard inquiry put onto your credit report. Having too many of these can show that you are applying way too often for credit, and that will lower your score. And when you open too many accounts at the same time, that will also hurt your score as well. That is showing the credit bureaus that you're frequently having new debt. Another thing that can negatively impact your score is going to be closing out credit cards. It's okay to close out a credit card if you've only had it for a little while. It'll only affect your score for 6 to 8 months. However, if you close out a credit card that's been on your credit for a long time, and it's one of your oldest trade lines, that's going to affect you negatively more. That is because it's going to bring down how long of a credit history you've had. Any collection accounts that you have on your credit report will stay on there for 7 years after the last active date. That will mean that anytime if you've made any payments on that collection account, it will be 7 years after that last date that you made a payment. When it comes to a profit and loss write-off, those will also stay on your credit report for the same amount of time in 7 years from the last active date. And for bankruptcy, you will see these on your credit report for 10 years from the date of discharge. Some ways to help your score improve from having these on there could be if you're able to pay off those collections accounts or profit and loss write-offs, as that will help to increase your score.
If you are thinking about applying for a new loan, your credit score will directly affect that loan's interest rate and term. For example, this is Sally. Sally has a credit score of 785, which is considered excellent. She has never made a late loan payment, uses her revolving credit responsibly, and has had a variety of different kinds of loans. Sally wants to buy this 2015 Jeep Grand Cherokee. The vehicle has 85,000 miles, and the seller has accepted Sally's offer of $16,500. Sally decides to take out a used vehicle loan for 60 months. She ended up with an interest rate of 3.25% and a monthly payment of $298.35. Sally will end up paying $1,401.15 in interest, which means that in the end, she will pay $17,901.15 for the vehicle. This is Bill. Bill has a credit score of 621, which isn't that great. He's had several late loan payments in the past, and he's only had a few auto loans and credit card in his history. Bill got the same exact vehicle as Sally and paid the same exact price to the seller. However, because of his score, his loan has an interest rate of 10%, and his monthly payment is $350.67. Bill will end up paying $4,541.32 in interest for a total vehicle price of $21,041.32. This means he's going to end up paying $3,140.17 more than Sally for the car. This is a prime example of how your credit score can affect future loans that you get. Taking care of your credit and maintaining a good score can save you thousands of dollars in interest down the road. Here's a side-by-side comparison of how much money 4 individuals with various scores would pay for the same 2015 Jeep Grand Cherokee if they paid the same purchase price.
Here's an example of a credit report. The first section of your credit report will include your personal information, such as your name, date of birth, your social security number, any current and former addresses you have, and any current and former employers that you've worked for. The next section of your credit report is going to show your credit score and the reasons for your score. Each bureau will normally provide at least 4 reasons for where your score is at currently. Next, it will give you a credit summary. This will be totals for each category of debt, such as credit card balances, installment loans that are reporting on your credit monthly. If you have any collection and bankruptcies, that will report on your credit next and show any former bankruptcies for Chapter 7, 13, or 11, and any profit and loss write-offs that have been put onto your credit report. Next will be your open trade lines. That will be all loans that you currently have, including credit cards, revolving debt. Each trade line will show your financial institution, the payment amount for each your monthly payment, the payment history, when you opened that account, and the starting and current balance, and any negative remarks. The last part of your credit report is going to show any inquiries that you've had. This will be for any time you've had credit pulled for any application for any debt to be obtained. This is going to show the financial institution and the date that that was pulled.
If you've ever used credit monitoring apps like Credit Karma and then applied for a loan, you might have noticed that the score you saw on the app was different than the score that your lender pulled. There are a few different reasons for why this can happen. First of all, Credit Karma uses VantageScore instead of FICO to calculate your credit score, so the scoring model they use is different and therefore results in a different credit score than what we see. Also, if you have loans with multiple institutions, not all lenders report to all 3 credit bureaus, so your score can vary between them. In general, apps like Credit Karma can be beneficial when it comes to monitoring your identity to make sure that no fraudulent loans were taken in your name and that your current lenders are correctly reporting your loan activity. But you shouldn't rely on the score itself when you get a loan, since it's likely not reflective of the score that your financial institution will pull.
Filing a credit dispute will not negatively affect your credit score, as when you file a dispute, you're filing on something that is based on your credit report that you believe is not valid information. If you do, however, dispute it and it is approved by the institution, it could be removed from your report, which in fact will have a positive effect on your credit score.
Filing a credit report dispute is 100% free, and like Eric said, there are no repercussions to filing, but your score can change if they accept your claim and remove the disputed item. Before you file, make sure you're filing with the correct reporting agency, Equifax, TransUnion, or Experian. The fastest, most convenient way to file is by doing so on their website, which is secure. However, if you're uncomfortable doing it online, you can call them or mail the dispute. Next, the reporting agency will contact the creditor who made the error. If they do not hear back from that creditor within 30 days, your request will be granted and the data will be removed. If they do hear back from the creditor within 30 days and it's determined that it was indeed an error, your request will be granted and the data will be removed. If they hear back from the creditor within 30 days but it's determined that it was not an error, your request will be denied and the data on your report will remain unchanged. For more information on filing, visit the credit report agency's website. If you don't have a lot of credit history and want to establish some, there are a few things you can do. One option is to take out a share secured loan. A share secured loan means that you use money in your savings as collateral for the loan. We would put a hold on the money, which means it would be frozen in your account until the loan is paid off. With every payment you make, a little bit of your share secured funds are released back to you. Once you pay off the loan, we will release the funds to you and you can do what you please with them. If you default on your loan, we use the remainder of your share secured funds to pay off the loan. Keep in mind though, that even though we already have the funds to pay off the loan, there's only enough to cover what you owe, so you will likely need to pay things like late fees out of pocket. If you don't have much in your savings, you might be approved for a small unsecured loan or a credit card with a lower limit. This is something that your loan officer will determine once they speak with you about your circumstances and take a look at your credit history and income. One final option, especially if you're looking at a particular loan but do not have enough credit history or a good enough score to qualify on your own, is to have a cosigner. The loan officer would take both the cosigner and your scores and income into consideration, so you have a higher chance of being approved, especially if your cosigner has a good score and mature credit history. However, your cosigner would be just as responsible for the loan as you are, so you both need to make sure you are comfortable with the arrangement. If one of you does not follow through with your part, especially if that part involves making payments, it will impact both of your credit scores. If your score is low, there are a few additional things you can do to improve it. The most important thing is to make sure that you make all of your minimum monthly payments on time. One missed payment can have a drastic negative impact on your score, and it will take time for you to make up with future on-time payments. Another step you can take to improve your score is to only use about 1/3 of your revolving credit at a time. This shows creditors that you're able to manage your available credit responsibly. For example, if your credit card limit is $2,000, consider using only about $500 to $750 at a time. Finally, if you are overwhelmed with late payments and delinquent loans, consider GreenPath Financial Wellness. They specialize in helping people make healthy financial choices and guiding them through financial crises. If you think this is the right path for you, speak with one of our loan officers and we'll help you coordinate with GreenPath. The sooner you reach out, the sooner they will be able to help. There are budgeting steps that you can take to help you maintain a healthy credit score. If you create a monthly budget, which includes your loan payments, and stick to it, you'll be more likely to make your payments on time. Also, if your budget includes putting money into savings, that savings can serve as a buffer if you're ever in a position where you don't have an income but need to make your monthly payments. Another helpful budgeting tool is to properly manage your DTI, or debt-to-income ratio. To calculate your DTI, take your total monthly loan payments and divide them by your monthly income before taxes. Multiply that number by 100 to get a percentage, and there you have your DTI. If your DTI exceeds 40% and you get behind on your monthly payments at any point, it can be very hard for you to catch back up. But knowing where your DTI is and keeping it in a healthy range, you will be more likely to make your payments each month and therefore keep your credit score on track. If you're looking for apps to help you with your finances, check these out. Mint was created by Intuit, who created TurboTax, and it is a secure way to monitor your credit score, sync all of your accounts from other institutions, track your spending, and manage your debt. Good Budget is an app which allows you to budget, track your spending, and pay down debt as well. There are two things that set it apart from other apps. For one, you can sync with other users, so you and your significant other can both have the app on your phones and keep up to date with one another regarding financial matters. The second thing that sets the app apart from others is that it's designed based on the envelope method, in which people used to have one envelope for each purpose, such as a rainy day fund, car fund, and so on. It allows you to compartmentalize your spending. Money Desktop is integrated into your online banking at the Michigan Tech Employees Federal Credit Union, but you can also download the app for use on your mobile device. You can sync your accounts from other institutions so that you can view all of your balances and debts in one place. There are tools to help you budget, track your spending, manage your debts, and set financial goals. If you'd like help with using Money Desktop, give us a call or stop by. Don't forget, you can now schedule a credit report checkup at any time, whether you're a member of the credit union or not. Just visit our website, use our mobile app, or call to schedule an appointment with a loan officer. We will do a soft pull of your credit, so it will not negatively impact your score, and we will go over all of your credit history with you to find out how we can help. Whether you just want to make sure that everything is okay, or you'd like assistance with improving your score. Thank you for watching this presentation. We at the Michigan Tech Employees Federal Credit Union hope that you learned some valuable tips about establishing, improving, and maintaining your credit score. If you have any questions, comments, or concerns, we invite you to call us, email us, or stop by during business hours. Thank you.